Jake buys a house. Marcus buys a screen full of numbers. Same $50,000, same Tuesday, same age, same paycheck. Jake hands his money to a closing attorney and walks out with keys to a rental property. Marcus clicks a button and gets an email confirmation. Both of them lean back that night, feeling like they just outsmarted the other one. And here's the thing, they're both wrong, because the choice they each think they made isn't the choice they actually made. And neither one will find out for years. When you run the real numbers across 20 years, after every cost nobody puts on the napkin, the result doesn't just surprise you. It changes how you'd think about your own money. So let's run it, all of it. Let's keep this fair, because the internet almost never does. Jake and Marcus are both 52 years old. They both earn $55,000 a year. They live in the same mid-sized American city, the kind of place where a $250,000 house is a real house, not a closet. They each have exactly $50,000 to put to work. Same starting line. The only difference, the only one, is what they do with that 50 grand. Jake buys a rental property. $250,000 purchase price, $50,000 down, which is 20%. He finances the other $200,000 on a 30-year mortgage at 7%. Marcus takes his $50,000 and drops it into a total market index fund, and then he adds $300 every month on top, automatically, and basically forgets about it. That $300 a month matters, so hold on to it. We'll come back to whether Jake has $300 a month to spare, because that's part of the whole story. For now, two men, same money, same city, same age, two completely different roads. And on day one, it's not even close. Jake feels like a winner. He's got an asset you can stand in front of. He's got a tenant who's going to mail him a check every single month. He's got a story to tell at the barbecue. Yeah, I picked up a rental this spring. He drives past the place on Sundays. There's something deeply, almost primally satisfying about owning a building. Marcus has none of that. Marcus has an app on his phone that shows a number, and the number even goes down some weeks, which feels like getting punched for no reason. Nobody's impressed at the barbecue when you say, "I bought the total market." Jake's choice feels rich. Marcus's choice feels like nothing. But feelings and math are two very different things, and over the next 20 years, one of these men is going to get betrayed by his feelings at least once, maybe both of them. Let's walk it out. Start with what Jake actually collects. The house rents for $2,000 a month. That's $24,000 a year, and that's the number everyone talks about. 24 grand off one house. But you don't keep 24 grand. You don't keep anything close to it. His mortgage payment, just principal and interest on that $200,000 at 7%, runs around $1,300 a month. Property taxes and insurance, call it another $500 a month, bundled in. So before he's fixed a single leaky faucet, Jake's housing costs on that property are roughly $1,800 a month against $2,000 coming in. That leaves about $200 a month. And now the real costs walk in the door, the ones that turn that $200 into a question mark. Vacancy first. No tenant stays forever, and no unit fills the same day it empties. Figure roughly 1 month of empty per year on average over the long haul. There goes $2,000 a year, which is most of that thin margin gone in one line item. Maintenance next. The rule of thumb is 1 to 2% of the property value per year, so on a $250 house, that's $2,500 to $5,000 a year, and it does not arrive evenly. It arrives as a water heater in February and a dead AC compressor in July. Then capital expenditures, the big stuff that doesn't happen yearly but absolutely happens. A roof is somewhere around $8,000 to $15,000. An HVAC system is $5,000 to $12,000. You'll repaint, you'll replace flooring, you'll redo a kitchen once a decade. Smart landlords set aside money every month for those, and if you don't, you're just borrowing from a future version of yourself who's going to be furious. Then property management, if Jake's smart enough to know he doesn't actually want to take her 11 p.m. call about a clogged toilet, that's 8 to 10% of rent, so call it another $2,000 a year. And then the one nobody prices in until it happens to them. The bad tenant. The one who stops paying, who you can't legally remove for months, who leaves the place needing 5 to 10,000 in repairs and a few thousand in lost rent and legal fees on the way out. It might not happen in year one. Over 20 years, something in that family of disasters happens to almost every landlord at least once. So here's Jake's honest number. That $2,000 a month in rent. That beautiful $24,000 a year after the mortgage and taxes and insurance and vacancy and maintenance and the money he should be setting aside for the roof and the furnace and management. His actual net cash flow lands somewhere around break-even to maybe $2,000 for the whole year. Not the month, the year. Some years it's a few thousand positive. Some years the AC dies and it's flat-out negative, and Jake is writing a check to own his investment. That's the part the guy selling you the rental property course leaves out. But cash flow was never really the point for Jake. And this is where it gets interesting, because the real engine is somewhere else. By year 3, two things are quietly working in his favor that don't show up in the monthly numbers. The first is appreciation. If that house gains roughly 3 to 4% a year, in line with long-run housing, in 3 years it's worth somewhere around $275,000 to $280,000. The second, and this is the one people underrate, is leverage. Jake's gain isn't calculated on his $50,000 down payment. It's calculated on the whole $250,000 asset, even though he only put up a fifth of it. So a $25,000 gain in the home's value is a 50% return on his actual cash in the deal. That's the magic of a mortgage. The bank's money is doing work for him. Add in the tenant slowly paying down his loan balance, 3 to 4,000 of principal knocked off that first year and climbing, and Jake's equity is building even while his checking account barely moves. Meanwhile, Marcus is doing the most boring thing in the world. His $50,000 sat in the market and at a long-run average of around 10% before inflation, call it 7% after, it's grown. Quietly, with some scary dips in between, and he's added $3,600 a year on top of it, that $300 a month. By year 3, he's somewhere in the neighborhood of $65,000 to $75,000, and he has done literally nothing. No phone calls, no repairs, no tenant. He doesn't even know his fund's ticker without looking it up. His work this year was not selling when the screen turned red for a few weeks, year 5, and the gap starts telling a story. Jake's house is worth maybe $290,000 to $300,000. His mortgage balance has dropped under $190,000. So his equity, the house value minus what he owes, is creeping toward $100,000 against the $50,000 he put in. On paper, he's doubled. He'll tell you that at the barbecue too, and he's not lying, but he's also not counting the years the furnace ate his cash flow, and he's not counting that his equity is locked inside a house he can't spend at the grocery store. Marcus, around year 5, is sitting somewhere around $90,000 to $110,000. All of it liquid. All of it one click from being cash. They are, weirdly, much closer than either of them would guess. If you stop the tape here, you could argue it either way. Year 7, and here's what's happening underneath. Jake refinanced or he didn't, but either way, his rent has climbed. Rents don't sit still for 7 years. So maybe he's pulling $2,300, $2,400 a month now, while his mortgage payments stayed fixed. His cash flow finally turns reliably positive, a few thousand a year he can count on. His equity is pushing past $120,000, $140,000, As the loan grinds down and the value drifts up, the leverage that felt invisible for years is now visibly multiplying a relatively small market move into a large equity gain. Marcus, 7 years in, is somewhere around 120 to 140,000 himself, and his contributions are now a smaller and smaller share of his balance because the growth is doing the heavy lifting. This is the part nobody has the patience for. They're still neck and neck. 7 years of effort, 2 radically different lives, and the scoreboard basically says tie. And then it gets worse for whoever thought it'd be a blowout by now, because the real separation hasn't even started. Year 10 is the surprise. Run it honestly, and these two are shockingly close, both somewhere in the rough zone of $200,000 to $250,000 of net worth from this one decision, depending on which year the roof went and which years the market ran. A decade in, and the great debate that the internet treats as obvious is, at the halfway mark, basically a coin flip. This is the single most important thing I can tell you, and it's the thing that gets buried under every real estate always wins and every just buy the index headline. For 10 years, it didn't matter much which one you picked. What mattered is that they both picked something and stuck with it and didn't bail in a bad year. And this is where the story fully separates, because the back 10 years do not behave like the front 10. Here's the engine difference that compounding hides until late. Jake's leverage shrinks as a percentage of his deal every single year. He started controlling $250,000 in assets with $50,000 of his own, 5-to-1. By year 15, he owes maybe $140,000 on a house worth $360,000, so his own equity is most of the asset now. His leverage, the thing that supercharged his early returns, has quietly faded. His house is now appreciating at 3 to 4% on a value that's mostly his own money, which is to say, it's behaving more and more like a slow, illiquid index fund that also calls you at midnight. Marcus has the opposite curve. His money has been compounding on the full balance the entire time, every dollar earning on every other dollar, and after 15+ years of that, the absolute gains per year start to dwarf his contributions. By year 20, run it out, and Marcus is likely sitting somewhere in the range of $350,000 to $450,000, liquid, no tenants, no roof fund, no 11 p.m. calls. Jake, by year 20, has a house worth maybe $450,000 to $500,000 with the mortgage nearly or fully gone, so call his equity $400,000 to $500,000. Plus, and this matters, 20 years of rent that, after all those costs, probably netted him somewhere in the modest tens of thousands total. Not the fortune the brochure implied. On the headline net worth number, they land close again. Closer than anyone wants to admit. Jake might even nose ahead. But the dollars don't tell the whole truth, and this is where you have to be honest about what each man actually went through to get there. Because if I only showed you the downsides of real estate, the toilets, the vacancies, the bad tenant, the roof, I'd be doing exactly what every index fund evangelist on the internet does, and I'd be lying to you by omission. So let me defend Jake honestly. That leverage I said faded? For the first decade, it was rocket fuel, and there is no equivalent in Marcus's world. No brokerage is going to let Marcus put up 50 grand to control 250 grand of stocks and ride out the swings. And if they did, one bad year would liquidate him. Jake got to control a $250,000 asset from day one, and the bank couldn't make him sell in a downturn as long as he made the payment. There's the depreciation too. The tax code lets Jake write off the building's value over time, a paper loss that can shelter real income, and that's worth real money every April that never showed up in my cash flow math. His mortgage is a 30-year fixed bet against inflation. He locked his biggest cost in today's dollars and pays it back with cheaper future dollars while rents rise around him. And his rent income tends to climb with inflation automatically, where a bond would just sit there losing ground. Real estate is a forced savings plan for people who would never have the discipline to send $300 to a brokerage every month. The mortgage makes you build wealth whether you feel like it or not. And don't let me pretend Marcus had it easy, because that's the other lie. Marcus's road looks smooth on a chart and was brutal to actually walk. He had to sit through 2008, watching that account fall by half, with every instinct in his body screaming to sell and protect what's left. He had to sit through the 2020 crash, weeks of headlines telling him the world was ending, and do nothing. The single greatest threat to Marcus's 20-year number was never the market. It was Marcus. The investor who panic sold at the bottom in 2008 and waited to feel safe before getting back in didn't earn that 10% average. He earned a fraction of it, or he lost money in the exact same fund that made the patient guy rich. Marcus also got no cash flow the entire time. His wealth was real, but it was abstract, a number that paid him nothing he could touch until he sold it. He had no leverage, no depreciation, no inflation-hedged income stream. He just had patience, and patience is a lot rarer and a lot harder than it looks on a spreadsheet. Both of these men needed a kind of discipline. Jake needed the discipline to manage a business. Marcus needed the discipline to do nothing while terrified. Neither one was passive. Anyone who tells you either path is passive income is selling you something. So when does each one actually win? In the real world, for a real person, not in the abstract. Real estate genuinely pulls ahead when the numbers under it are unusually good, and you have to know what good looks like. A strong rent-to-price ratio is the whole game. The old 1% guideline, where monthly rent is around 1% of purchase price, almost never exists anymore. But the closer you get, the more real estate dominates, because the cash flow stops being a rounding error. Jake's deal at $2,000 rent on $250 was 0.8%, which is why his cash flow was so thin. Find a place where $250 rents for $2,200, and the math transforms. House hacking wins enormous. If you buy a duplex, live in one side, and rent the other, you get an owner-occupant mortgage with far less down. Your tenant covers most of your housing cost, and your own rent drops towards zero while you build equity. That's one of the genuinely best moves in personal finance for someone willing to share a wall. And the 1031 exchange is the rich man's cheat code. When Jake sells, he can roll the entire gain into a bigger property and defer the capital gains tax indefinitely, stacking properties across decades and never paying the tax until he dies, at which point his heirs may get a stepped-up basis, and a lot of that tax evaporates. Marcus has nothing that clean. Real estate also simply wins for the person who will actually do it, who will screen the tenant and fix the thing, but does nothing for the person who buys a rental and then ignores it into the ground. And index funds win clean for almost everybody else. They win for the person who travels, who has a demanding job, who doesn't want a second unpaid career as a landlord. They win on liquidity when you need $10,000 next week and you can have it in 2 days instead of refinancing or selling a house over 90. They win for the person in an expensive market where no rental cash flows, no matter how you torture the spreadsheet. And they win quietly for the person who's honest enough to admit they will never ever manage a property well, but they will set up an automatic transfer and leave it alone for 20 years. So here's the real trap. And it's neither of these two men. The real trap isn't real estate, and it isn't index funds. The real trap is picking either one because of a YouTube headline, or because of a guy at a conference with a rented Lamborghini, or because of something your brother-in-law swore by at Thanksgiving, and never once running the full numbers for your own situation, your own city, your own discipline, your own stomach for a tenant's phone call or a market crash. Jake and Marcus both did fine over 20 years, not because real estate or index funds is the right answer, but because each of them picked the path that fit who they actually were, and then they didn't flinch. The wrong house bought by the wrong person loses badly. The right index strategy abandoned in a panic loses just as badly. The vehicle was never the thing. You were always the thing. And if you're sitting there wondering what happens when you stop treating this like a cage match and you do both, you buy the house and you fund the index. You use the rental's cash flow to feed the brokerage. You let the leverage and the compounding run side by side instead of against each other. That is a completely different conversation. And the numbers on that one are genuinely something to see. We'll run it. Because the only number that ever mattered isn't the one on the headline or the one your uncle bragged about. It's the one that's left after you've put every single cost on the table, looked at it honestly, and counted what you actually get to keep.